What is up, you guys? Pete DiCarlo here, and today we're going to talk about put credit spreads and call credit spreads. So in this video, we're going to go over why I feel that they are the superior way to play options, in what instances should you use them, what is the best way to find the most amount of risk for the most amount of reward, and vice versa, and overall why I think that it's the best way for you to trade. So guys, hit the like button, subscribe, and all of this is going to be based around the fact that you guys understand what selling a cash secured put is and what selling a call is. So if you guys haven't already, watch the video that I put out. Just go to YouTube, type Peter DiCarlo selling puts, and the first one should come up here. It says passive income, and I will also try to remember to put it within the description, but sometimes I forget because I put so many videos out. I'm sorry. But watch that unless you already understand what selling a put does, because that is basically one piece to doing a credit spread. So hit the like button, subscribe, and let's get started. So first thing I want to do is go over to TD Ameritrade, and let's just take a look at something like, let's look at Wish. This is going to be a good example here. So a lot of the times when you guys want to play a options trade on something like a small cap company that has a ton of volatility, like a Wish, like a Cassava Sciences, like a SoFi or a Skills, anytime that you want to play something like that, what tends to happen is it's going to have high implied volatility. And this is the number one reason why I like to trade cash secured, or not only cash secured puts, but spreads in general. Doing a put credit spread is best when you have high implied volatility. So what is high implied volatility? High implied volatility is really when implied volatility is over 60 to 70%. When it's over 100% is really when it's at its worst. Implied volatility goes up and down based off of, you guessed it, volatility. So if a stock has earnings coming up, or if a stock is up about, massive, like 10, 20, 30% within the past couple of days, implied volatility is going to rise because the volatility of the stock is going to rise. Let's say that bad news came out and the stock dumped, implied volatility is going to rise. Or even if the stock has been stable-ish, such as like Wish has really just been trading sideways for the past like 30, 40 days, implied volatility can still be high if those moves are massive. Now, when implied volatility is high, it's going to end up moving what's called your Vega and your Theta. And I want to talk about that. We can go back to Wish here, but I want to talk about that using Robinhood, because even though I don't like Robinhood as a broker, the user interface specifically for options is one of the easiest ways to teach, and that's why I like to use it. So what you can see right here is this is, we'll go to August 20th, so we'll have more time on our hands here. But what you can see is that if we were to play like a $10 call, which if you guys don't know what a call is, you think the stock is going to go up. You can see that implied volatility is up 130%. So already I would not play a straight up call on this, because since your implied volatility is up, your Vega is going to go up. And when your Vega goes up, it raises your Theta, which your Theta is the decay of the option. Every single option that you buy is going to decay over time. So that means like as soon as you purchase this is going to start decaying $42 per day, which is pretty crazy. So in the end of the day, that's bad, because it's kind of like a poison drip. As soon as you end up grabbing it, it starts to poison you and then destroying the position entirely. So you want to stay away from trading to the upside or downside by just buying calls or puts, anything that has a high implied volatility of over like 60 or 70%, because you can see that, for the instance of AMC, which I did the video on my Traders Helping Traders channel recently, but you can see that even if you bought a put today and AMC is down 6%, even if you bought a put, you would be down. You would still be down, right? The stock went the way you wanted to. It actually dropped significantly and you would be down 30, 40%. Some of these are down 50%, even though the stock went the way that you wanted. So that is why we do a spread, because you don't want to deal with implied volatility. You don't want to deal with IV crush. You don't want to deal with Theta decay, and you don't want to deal with Vega moving up and down. These are all bad things for options traders, and this is why 90% of options expire worthless. And you have to think to yourself, if 90% of traders fail, and if most of those traders fail because they trade options, and options expire worthless 90% of the time, no wonder why everybody is losing money and they're unable to do this on a consistent basis. So then you have to think to yourself, well, what's the opposite of that? If everybody's buying options and they're losing money, then what should I be doing? The answer is selling options. And that is what I do. Now, like I said, go back and watch the selling puts video that I talked about, because when you sell an option, you are the opposite of what that position initially was. So like we said before, if you are someone who is buying a call, you believe that the stock is going to go up. That means that if I am selling you a call, I am on the opposite side. So if you're buying a call, you're bullish. If I'm selling you that bullish position, if I'm selling you that call, I am bearish. And inverse, if you are buying a put, you are bearish. And if I'm selling you a put, I am bullish. So think of them as exact polar opposites. Buying and selling are the exact opposite in which way that position initially was meant to be played. So I'll give you an example of selling a cash secured put first. So let's take a look at AMC. We're going to look at an expiration date of today, which is, of this Friday, which is August 13th. So if I sold a $30 put, I'm going to go to sell, I'm going to hit put. If I just sold the put, you can see that as long as the stock closes above the strike price that we picked, which is $30, I will make $102 for every $2,899 that I put up. And the worst case scenario is, if AMC closes even a penny below $30, I am forced to buy 100 shares of AMC. I still get to keep the profit that I made for the selling the premium, but I get to actually buy the shares. So not bad at all, right? Worst comes to worst, you get to buy shares in a company that you hopefully like, and you get to keep the premium at which you sold it. And the good thing is about doing cash secured puts and spreads, which we're going to talk about in a little bit now, with that AMC example, if the stock ripped, 10, 20, 30%, you still make 100% of your profit. If the stock sat completely sideways until your expiration, you still make 100% return on your profit. If the stock dumped, but then bounced and closed even a penny above $30, you still make 100% return of that, or not 100% return, but 100% of that premium in which you sold. So you'd make $100. So you can see that normally when you buy an option, you only make money if the stock goes massively to the way that you bought it. So if you bought a call on AMC, you'll only make money if AMC rips. If you get a put on AMC, you only make money if it goes down. If you sell a cash secured put, you make money if it goes up, you make money if it goes sideways, and you make money if it goes down a little bit. Now, the issue with selling a put is that it costs a lot of money because it's the strike price times 100. So in order to sell a $30 put, you're going to have to put up $3,000. So let's say number one, you don't have $3,000, or number two, you don't want to risk $3,000. What you can do is called a put credit spread. And that's really what we're talking about. I know we're 8 minutes in, but it's important that you guys understand all these other aspects before we actually talk about putting on the trade. So what you're going to want to do for a put credit spread, find a strike price that you believe the stock will not close below. So let's continue with this $30 put on AMC. So we think AMC will not close below $30 come this Friday. So what you're going to do is sell that $30 put, because remember, we're bullish. We don't think AMC will close below 30 bucks. Now, what we're going to do to lower the amount of money that we have to put down is we're actually going to buy a put. Now remember, buying a put is bearish. So we have a bullish position at $30 because we're selling a $30 put. Then we're buying a bearish position right below it at 29. And what this is going to do is act as an insurance policy. So this $30 put is bearish, is bullish, and the 29 is bearish. And what you're going to see is that now, instead of having to put up, $2,900 to make $93, we only have to put up $71 to make $30, which is crazy. That's literally like a 40% return within just a couple of days, as long as AMC closes above 30 bucks. So like I said before, if AMC goes up, we're going to make 40% returns on our money. If AMC goes sideways, we're going to make 40% returns on our money. If AMC dumps down to 28 bucks and then closes even a penny above 30 bucks by this Friday, we're going to make 40% returns. So that's the power of a put credit spread. Now, what's the worst case scenario here? Remember when I talked about if you sell a put, the worst case scenario that happens is you are stuck buying 100 shares of AMC. Well, when you're doing a credit spread, the worst case scenario is you lose all the money that you put up. If it closes even a penny below 30 bucks, you lose all of this money that you ended up putting up. But at the end of the day, to me, that's worth it, because look at this. If we're selling this 30, we have a 72% chance of making money. So at the end of the day, that is the power of a put credit spread. Now, there are different ways to mess with this. The closer that you go to the share price right now, the lower chance you have of making money. So you can see that if I did a put credit spread for a 31 and a 30, I only have a 67% chance of making money. But you can see that if I go ahead and do this, I only have to put up 61 bucks to make $40, which is crazy. So if you only have $100 to your name, you can almost make a 50% or 60% return on your money overnight. Now you can see here that if we actually go further out of the money for this one, there's like a 95% chance that we're going to make money. So if we were to go ahead and sell a 24 and then buy a 23, you can see that I'm going to have to risk $100 to make $3. So the chances of making money are significantly higher the further you go away from the in the money strike price, but the less money you're going to end up making. So you want to find a good happy medium between risk and potential reward. At the end of the day, though, what you're really going to want to look for is volume. You want to make sure that there's high volume on both of the strikes that you're looking at. Like this would be a good one because 28 and 27, because you have to remember these positions, like even though the position's a put credit spread, it still has to fill two options at one time. So you have to make sure there's a lot of volume so you can get in and out of the position, so you're not just stuck with some position that you don't want to have anymore if you're up or if you're unfortunately down. Now let's look at how we can do this with a bearish position. And also, just to give you guys a quick heads up, you'll know that you're doing this right because Robinhood will actually tell you. So it should say put credit spread. If it says something like, custom, that's wrong. You don't want to do that. So it'll tell you put credit spread, call credit spread if you do it right. So now let's say you're bearish on AMC. What you could do is pick a strike that you believe AMC will not close above this Friday. So let's say you think AMC will not close above $35 by this Friday. I'm not saying that this is the case. I'm just using it as an example. Now you're going to do the opposite. So instead of selling a put and then buying a put below it, you're going to sell a call, right? Because this is bearish. We're going to sell a $35 call, and you can see we have an 80% chance of making money, and there's a ton of volume on this, so that's a very good sign, and implied volatility is through the roof, which is good for a seller. So we're going to sell a $35 call, and then we're going to buy, instead of buying the one below it like we did with the put, we're going to actually buy one above it. And you can see if you do it correct, it's going to say call credit spread. It's going to show you as long as AMC closes below $35 by this Friday, you will make $17 for every $83 that you put up. So that's massive. And like I said, you can go further out of the money and make less money but have a higher chance of making money, or you can go right up next to, the strike price and make a ton of money but also risk more money. And like I said before, with this, it's the same situation. If AMC dumps, you're going to make all of that money. If AMC goes sideways, you're going to make all that money. If AMC rips, but then pulls back and closes below $35, you're going to make all of that money. So guys, I'm sure that some of you have questions. Please comment down below. That's the point of this video, is for you guys to comment and let me know, and then I can either make a video updating, some of your questions, or I can just respond in the comments. But guys, this is the superior way to trade. It really is. And if you guys are having issues and you really want to learn, I am giving away 1 month for free of my private academy. You get access to our 60-hour course library teaching all of this. You'll get access to our Discord. You'll get access to every single trade that I take live, and you'll get access to my daily live streams. I live stream with them every single morning for the first hour of market open. Guys, thank you for all the support. It truly means the world to me. Hit the like button, subscribe, and I'll see you next time.